So, hello everybody. I hope everybody's having a great day. No trade calls, recommendations, or responsible on stuff here for educational purpose only. Here we go for another one of these Substack videos. Had a couple of people asking me for an update on the SPX framework. So here goes. Basically, we have broken above that 7,000. And if you remember, our targets to the upside haven't changed. So basically, we've got 7,404, 7,962, and 8,211 to the upside. Those targets are all in play. Now, the question is how to deal with this reversal we saw on Friday and going forward. Now, keep in mind that in this configuration, we could easily see a retracement off those highs, which comes back into the breakout point, which is 7,000, which would be about 3.7% correction, or this could easily come back all the way into the range breakout level at the 6,800 back into the 200 DMA, and that would be about a 7% correction. So, it still holds the structural integrity of the bull run, even if we pull back. Now, the question is, you have to be careful because clearly this is a market that's driven on headline flow. And even though it's rallied on what we would say poor structure, poor breadth, it is what it is. Now, the question is, after we've had double-digit monthly gain, after we've had the fastest recovery of a over 10% loss in the SPX, which took pretty much 11 days, previous fastest was about 55 days. After we've had a double-digit month of April, right? Would you come into here and panic buy long because sky's the limit? Probably not, right? All things being equal, of course, all-time highs are bullish. A double-digit monthly return is bullish, 3, 6, 4 months down the line. The question is that in the shorter term, in the medium term, you have to be a little bit cautious. Now, how would we read this? Usually, and again, I'm recording this on a Sunday, we could get Iran headlines and we could gap up 5% for all I know. But normally when you tend to see these kind of reversals, especially on poor breadth and with the kind of action we've seen, usually you've got fairly high odds that the market at least wants to come back and test the 10-day moving average. So here your base case assumption going into the week would be that the market will kind of stall, try and test the 10-day moving average, and then that will be the next short-term bull bear line at the beginning of the week. Also because, we ended the month on Thursday. We had Friday was the first day of the month. Usually first day of the month has an even more bullish drift than usual. So if we're going to pull back, it makes sense that it happens now as we go into the new trading month after the first day of the month flows. So going into the week, you'd look at this as the first bull bear line, a move back into the 10-day that holds, then you would expect this to continue to try moving aggressively in extensions to the next upside target. A move below, you would look for this to come back down into that previous all-time highs into the 7,000, and then that would be the next bull bear line. And those are all bull bear lines the way we'd continue to look at things. So really the structure hasn't changed much, but what you do have to be careful is that, again, there's been panic buying. Now, I know a lot of people saying it's probably impossible for this to correct until NVIDIA earnings are out. We'll have to see, but I think the main message is, number one, the framework is intact and the levels continue to serve as bull bear lines. Number two, it would not be surprising after this kind of speed of recovery, this kind of monthly close, to see a little bit of a sideways to down action. Number three, don't be fooled even if you do see a little bit of more aggressive downside action, unless we break back below the 6,800, have daily closes below the 200-day moving average. This is still a healthy correction that could be, that's likely going to get bought aggressively. And finally, just keep an open mind. It's not a market to trade your bias. It's a market to focus the levels. Also, we've seen a lot of things moving in a little bit, let's say, unorthodox ways. So when you see the market moving like this, when you see usual relationships not necessarily playing out as they usually see, when you see, 70+% of the move being driven by 10 names in the midst of, BOJ action, et cetera, my recommendation would be to, again, park your bias and then to treat each chart individually. if things need to snap back into sync and everything's going to move into sync on a clear catalyst, on clear new information for the market, then you can go back to focusing on correlations and looking at things the way you'd usually look at them. But when things are a little bit messy, it always pays to be very unbiased, but to look at each chart independently and understand that because of the lower volumes, because of the time of the month, because of the way things are trading, things can be a little bit out of sync. Okay, so hope this was useful. Wishing everybody an awesome one. Talk to you guys soon. Take care. Bye.